on to the big reason we have gathered. It is really my pleasure to introduce today's speakers. We have Brian Beaupre and Thomas Long. With that, I'm just going to say hello to the both of you, and I'm going to hand it off to Thomas at this point. It's all yours, Thomas.
Brian, for being here as well. I'm Thomas Long. I'm a senior product marketing manager at TripActions. We're a travel corporate card expense management platform, and we're going to go through some very interesting stuff today. So with that, Brian, I'll let you kind of introduce yourself and what you guys do over there.
Sure. Thank you, Thomas. So Brian Beaupre, CFO of Takeometrics. Takeometrics is an ad optimization platform where we combine intelligent SaaS AI with what we call humans in the loop to help optimize your ad spend across e-com marketplaces. So Amazon, Walmart, Target, Shopify. Really our kind of differentiator in the market is the ability to, combine this kind of world-class SaaS-based AI with cost-effective humans in the loop, which really our competition, really can't differentiate with. And so been with the company for just under a year. So obviously been through, quite the roller coaster ride as it relates to what we're going to talk about here today, as it relates to cost savings, improving the shape of your P&L while also being a catalyst and enabler for growth. So hopefully that gives you a bit of background on myself, my tenure here. Just a bit more background. I've been a SaaS operator for the majority of my career, 15 plus years. I've been an individual contributor, manager, CFO, head of finance across startup, mid-market, enterprise, been through a couple acquisitions, notably with NetSuite and Cisco. More recently was head of finance for a TPG Capital DevOps venture known as Digital AI for 2 years prior to joining Takeometrics. So sort of been the custodian for the financial envelope across everything from bootstrap, VC backed, PE backed public companies, and so I think I have a decent perspective to bring to the table. But I think as all of us can attest to in this climate, we're all continuing to learn and adapt, and I'm certainly no stranger to that. So I'm happy to be here and share whatever insights I can with the group. And I'm sure many of the folks here that are on the call I've tapped into for advice, in the various networks we're a part of many times. So it's a collaborative effort. And so thanks for having me.
Awesome. Thanks so much, Brian. Cool. With that, let's jump into it. And for sure, if anybody has any questions or thoughts or anything, feel free to throw them in the chat anytime. We're happy to take them. So with that, let's jump a little into growth and cost savings. So obviously, this is kind of playing off that question is, the economy is tightening, right? The Federal Reserve is raising rates, doing QT, right, as you guys all know very well. So with that being the case, a lot of companies are looking for ways to save money, and increase their runway, their margins, things like that. So I guess, Brian, would love to talk to you about this. There is always a trade-off between, solving for top line growth and then optimizing, operating expenses, cost of goods sold to make your margins better. So when you're in, various stages of company / in the type of market we're in today, how do you think about that trade-off?
Yeah, it's a great question. One of the things I would say, to all finance executives that are on this call that are listening, I think if you put a poll up there right now and said, if you took a look at your entire expense envelope, for example, and said, are you 100% optimized across that? The answer unilaterally is no, you're not optimized. And so I think from a CFO standpoint, first and foremost, when you come to challenging times like this, you need to turn over every rock and figure out where are you under optimized across your spend envelope. And so whether that's in your tech stack, on T&E, in marketing, you really do have to double click into everything. And so I think that piece of it is critical is first and foremost, just to be intellectually honest about, okay, in these toughest times, like where do we have pockets that are the least efficient, that are the least optimized, and we need to get our teams to dig into that. I think the other piece of it too, as you think about growth, the best finance resources, that I've ever worked with, and the best FP&A resources, I think in particular, are those that treat cross-functional partnerships like an opportunity to educate folks in terms of why you need to have P&L health and P&L responsibility. It can't be hiring straight ahead to underpin growth in perpetuity. Companies basically index towards hiring. You need to then get to capacity to show the efficiency and the ROI from those investments. And then hopefully you've convinced your board, you've convinced the market that you're able to now spend, that you have efficient CAC payback on those dollars that you're spending cross-functionally across your stack, so that when the time comes, when the market inevitably rebounds, that you're in the position to show that, look, I'm better than my competitors because I can get the most out of the dollars we're going to invest. And so I think the ability to communicate that, especially in tech-oriented businesses, I think is key. And so I think there's a tactical component to it. And then I also think there's kind of a business partnership, which is, the folks that we deal with in finance on a daily basis, doesn't mean they necessarily have complete command or long-term vision in terms of what financial ROI looks like. And it's our job to educate them on that and basically to take complex long-term principles, distill it down to what matters to them and why this is important to you. If we're able to show more efficiency here in the next 6, 9, 12 months, whatever it may be, now we have a compelling value prop to tell the board. Now your hiring envelope for when we do now need to index more towards hiring again, you're going to get a bigger piece of that, which is going to underpin growth. So hopefully that makes sense.
Yeah, no, I mean, 100%. And I mean, I'm, being in Silicon Valley, we've definitely seen a shift in the past year or so where, a year ago it was like grow at all costs, it felt like. And now there's a little bit more of like VCs are, looking a little bit more at like, the unit economics and the margins and are you doing things intelligently and, actually bringing a return on every dollar that we're putting in. So yeah, that's definitely a shift that's going on. So great. So next question is, a lot of companies at different stages, they spend money on a lot of different things based on the industry, based on where they're at. So I guess just at your organization or other organizations that you've been a part of or seen, what tend to be kind of the biggest costs and costs that have surprised you, as you run these businesses?
Yeah, big smirk on my face here. So I think you can kind of approach it in two different ways. I would say first and foremost, an under-optimized and redundant tech stack to me is number one, and is something that I've seen across the board for companies that are going from that scrappy growth phase to hitting that inflection point where now you need to scale and you need to optimize. So many stops in my career, have I basically encountered redundant technologies across the board. And companies that don't necessarily have the right telemetry to even see that redundancy because it can get buried inside of other metrics and it can get abstracted in terms of, well, are these key metrics that we're focused on trending the right way? I don't need to look at these certain areas. But when times get more challenging, either from a macro or a micro standpoint, requires you to dig deep into those things. And so for me personally, having redundancy in the tech stack across the board and lack of ownership and transparency into that has been a huge piece of that for me. There's no question about it. And then I think the other piece, and then the other piece is the hidden costs that don't necessarily show up on your P&L, but when you think about preserving balance sheet cash, I think of a lack of focus on net working capital optimization and what those work streams need to look like across the business. At the end of the day, obviously we're looking to improve our EBITDA profile so that we can have more cash on the balance sheet so you can have more optionality. I think companies that don't have a hyper focus on that and have that sort of cash culture are at a disadvantage, and it's not something that can be stood up overnight. There's a lot of different vectors to it. And so sorry for jumping in there, but I do think that that's critical as well.
No, I mean, those are both great answers. Yeah, I mean, I was at just for, where I work at Trip Actions. I remember at the beginning, we had like 300-400 employees, and now we're at, almost 3,000. And so just going off your first point on the software, there's so many different tools that we had to kind of get rid of or kind of audit and, make sure we didn't have duplicate software. And, I know that's certainly something that our chief accounting officer is always worried about. So that's certainly something that, it's kind of low hanging fruit in terms of ways you can cut costs. So makes a lot of sense.